Investing can seem complicated. There are many different things to invest in: stocks, bonds, real estate. Today we are talking about bonds, specifically international bonds. A bond is like an IOU. You loan money to a company or government. They promise to pay you back with interest. International bonds are simply bonds issued by entities outside your home country. For example, if you live in the United States and buy a bond from a company in Japan, that's an international bond. Why invest in international bonds? One reason is diversification. Diversification is like spreading your eggs across multiple baskets. You don't want all your eggs in one basket, right? The same goes for investing. International bonds can offer different returns than bonds from your own country. This is because economies around the world don't always move in the same direction. When the US economy is down, another country's economy might be booming. This can potentially lead to higher returns for your portfolio. Remember, investing always involves risk. International bonds can offer several benefits for investors. We already talked about diversification. But there are other advantages too. One benefit is the potential for higher returns. Remember, different countries have different economic conditions. Some international bonds might offer higher interest rates than bonds from your home country. This can lead to greater returns over time. Another benefit is currency hedging. When you invest in international bonds, you are also investing in a different currency. For example, if you buy a bond in Japanese yen, you are betting that the yen will hold its value or even increase in value relative to the US dollar. If the yen strengthens against the dollar, you will make more money when you convert your yen back into dollars. Of course, the opposite is also true. If the yen weakens, you could lose money. While international bonds can offer attractive potential returns, it's important to remember that all investments come with risks. One risk to consider is currency risk. As we just discussed, changes in exchange rates can impact your returns. If the foreign currency you are invested in weakens against your home currency, your returns will be lower. Another risk is political risk. Political instability or government changes in a foreign country can negatively affect bond investments. It's important to research the political climate of a country before investing in its bonds. Credit risk is another factor to consider. Just like companies in your home country, foreign companies can also default on their debt. It's crucial to assess the creditworthiness of the issuer before investing in their bonds. Lastly, keep in mind that international bonds can be less liquid than domestic bonds. This means it might be harder to sell them quickly if you need to access your money. There are many different types of international bonds. One type is sovereign bonds. These are bonds issued by governments. For example, if you buy a bond from the government of Japan, that's a sovereign bond. Another type is corporate bonds. These are bonds issued by companies based in foreign countries. You can also invest in international bonds through mutual funds or exchange-traded funds, ETFs. These funds pool money from many investors to buy a diversified portfolio of international bonds. When investing in international bonds, it's important to have a strategy. One strategy is to focus on diversification. Don't put all your eggs in one basket. Another strategy is to look for undervalued bonds. These are bonds that are trading for less than they are worth. With careful research and a sound strategy, international bonds can be a valuable addition to your investment portfolio.